Welcome back to the Deep Dive, the show engineered to cut through the noise and deliver the essential insights you need to truly understand a business. Today, we're plunging into the world of T-Mobile US Inc., the company you might know as TMUS. Now, our mission for this deep dive is ambitious. We're setting out to determine if T-Mobile truly embodies what we call a wonderful company. You know, the rare kind you might consider holding in your portfolio for not just a few years, but potentially decades. This isn't just about a stock ticker, not about short-term market movements. It's really about peeling back the layers to understand the fundamental quality of the underlying business, its enduring competitive advantages, and its true long-term potential, especially in an industry that has, woven itself into the very fabric of modern life. We're going to push past the headlines, beyond the quarterly reports to try and uncover what truly makes this company tick, or indeed what might slow it down.
That's quite the audacious goal, isn't it? A multi-decade holding period. That's an extraordinary claim for any business, especially in an industry as dynamic, as fast-moving as telecommunications. So, to truly scrutinize such a bold assertion, we absolutely must move beyond just, surface-level observations. Our journey today will systematically dissect the core mechanics and the strategic choices that have forged T-Mobile into the powerhouse it is today. We'll examine it through several critical lenses: its foundational business model, the formidable strength of its competitive advantages, the foresight and integrity of its management, its rock-solid financial resilience, and finally, its current valuation. Our ultimate aim is really to equip you, the listener, with a robust framework, like a mental toolkit for analyzing any complex business, not just T-Mobile, to truly see if it stands up to this kind of rigorous scrutiny. So yeah, let's embark on this deep dive.
Absolutely. Let's start at the very beginning. To understand T-Mobile's enduring fortress, we first need to grasp its foundation, the business itself. How does T-Mobile actually make money? What's the core engine, of this enterprise?
Well, it sounds almost too simplistic for a company this scale, but at its heart, the business model is elegantly straightforward. T-Mobile builds and meticulously maintains a nationwide wireless network, right? And then sells access to that network through recurring subscriptions. That simplicity actually in itself is a profound strategic strength, as it funnels into incredibly predictable revenue streams.
Okay, so if we break down those revenue streams, where does the real power lie? Where's the core?
The vast majority, roughly 77% of their total revenue, springs from postpaid services. This is unequivocally the heart of the enterprise. It's the crown jewel, really. Think of these customers as the highest quality. They're credit checked, billed monthly, and they represent the primary engine of T-Mobile's profitability and, critically, that predictable cash flow. Why are they so valuable? Well, because their lifetime value is significantly higher due to remarkably low churn rates. They stick around for a very long time.
Right, low churn is key. And then alongside that core, you have other segments playing crucial supporting roles, I assume.
Exactly. About 15% of revenue comes from prepaid services. This includes T-Mobile's own prepaid brands, plus, well-known names like Metro by T-Mobile and the recently acquired Mint Mobile. These serve a slightly different, often more budget-conscious customer segment.
Okay, got it. Postpaid and prepaid. What else?
And then there's a smaller but growing slice, roughly 8% of revenue generated from wholesale and other services. This encompasses revenue from mobile virtual network operators, or MVNOs.
Ah, right, like Boost Mobile or Google Fi, those kinds of players.
Exactly. Companies that lease access to T-Mobile's network and then resell it under their own brand. This segment also includes nascent but potentially significant emerging revenue streams like advertising services or even enterprise IoT connectivity, things like that.
Interesting. And the final piece of the revenue puzzle, the one people maybe see most directly, is equipment sales, selling the actual phones.
That's right. This is where they sell you that shiny new iPhone or the latest Samsung Galaxy. It's a substantial revenue line, yes, but it's fundamentally a low-margin activity.
So not where the big profits are?
Not directly, no. Its true purpose isn't to generate massive profits from the device itself, but rather to attract and retain those high-value postpaid service subscribers. They're making their money on the recurring service, not really the one-time phone sale. It's the classic razor and razor blade model at play. Precisely. And for the long-term investor, what's truly compelling here is the sheer endurance of this simple business model. Consider this. Reliable connectivity, the kind T-Mobile provides, isn't some fleeting trend, is it? It's moved beyond a luxury to an essential utility, deeply embedded in every facet of modern society, much like, electricity or clean water. The human craving for constant connection coupled with the exponential rise in data consumption. I mean, these are powerful secular trends that are only intensifying.
Yeah, absolutely. So as we see technologies like the Internet of Things, advanced AI applications, immersive augmented reality become more mainstream, the underlying demand for ultra-fast, low-latency, high-capacity networks like T-Mobile's isn't just growing, it's set to skyrocket, right? This business model is almost, in a fundamental sense, future-proof, or at least very resilient.
That's a strong way to put it. I think largely accurate. The business is anchored to a fundamental, enduring aspect of human behavior in this digital age. And here's where that simplicity blossoms into a profound strategic strength. That recurring, utility-like revenue stream offers an extraordinary degree of predictability. This allows T-Mobile's management to forecast future cash flows with an unusually high level of confidence.
Okay.
That confidence, in turn, empowers them to commit to massive, multi-year capital investments into critical network infrastructure. Things like acquiring crucial spectrum licenses and building out, millions of cell towers. And these gargantuan investments then enhance the quality and reach of the network, which naturally attracts and retains more subscribers.
Right, which feeds back into more revenue.
Exactly, creating this beautiful, virtuous, self-reinforcing cycle. The model's simplicity isn't a weakness. It's a bedrock upon which their strategic strength and long-term viability are built.
Okay, that makes perfect sense.
Mm-hmm.
And this brings us to what's truly fascinating, isn't it? The very heart of T-Mobile's competitive advantage. Its economic moat. We're talking about a
Huge. That merger wasn't just about combining customer bases. It granted T-Mobile an unparalleled, truly unique trove of this essential mid-band asset. This is a foundational advantage that competitors, quite frankly, simply cannot easily replicate. I mean, to even begin to catch up, they would have to spend years and tens of billions of dollars on acquiring and deploying comparable spectrum. And that's a really tough task.
Okay, so this isn't just theoretical. How does this deep, wide moat actually manifest itself in the real world? How do we see it affecting T-Mobile's performance day to day?
Oh, we see it in incredibly clear, tangible ways. For instance, T-Mobile has consistently led the industry in postpaid phone subscriber growth, quarter after quarter, year after year, all while simultaneously expanding its profitability. That's key. For years, they've masterfully marketed their Un-carrier value proposition, offering plans that consumers genuinely perceive as a superior value.
Yeah, the taxes and fees included, the Netflix deals.
Exactly. Things like transparent pricing with taxes and fees bundled in, or popular streaming services included at no extra charge. It's a stark contrast to the often opaque, add-on heavy pricing models of rivals like AT&T and Verizon. Now consider this. A competitor burdened with a less efficient, higher-cost network simply couldn't sustain such a value-centric offering without severely damaging their profit margins.
Right, they couldn't afford it.
Pretty much. T-Mobile's superior network architecture allows it to handle a greater volume of data traffic per dollar of capital invested. This structural efficiency gives it the unique ability to offer customers more for less, better service for a better price, while still generating excellent and, crucially, growing returns on its capital. Their Q2 2025 earnings results were a perfect illustration, showing record postpaid phone net additions alongside a robust 5% growth in average revenue per account, or ARPA.
Okay, so ARPA, that's the average amount each account is spending.
That's right. And growing ARPA while adding customers is a powerful signal. It means T-Mobile is taking high-quality market share, not just engaging in, value-destructive discounting. It's a sign of true pricing power derived from that network superiority.
And the powerful thing is, you're saying this moat isn't static, it's actually widening. Their closest competitors, AT&T and Verizon, are genuinely years behind in deploying a comparable nationwide mid-band 5G network. They were effectively forced to spend tens of billions of dollars in recent C-band spectrum auctions just to acquire the raw materials, the foundational assets, to begin catching up.
That's exactly it. While they are now deploying that spectrum, T-Mobile is pressing its multi-year head start, transforming that lead into new growth. They're leveraging their network superiority to expand into new and historically underpenetrated growth areas.
Like where specifically?
Well, we're talking about capturing market share in rural and smaller markets, or maybe they weren't the strongest before. Aggressively pursuing large enterprise customers through their T-Mobile for Business division. That's a huge opportunity. And critically, dominating the fixed wireless access, or FWA, home internet market.
Right, the 5G home internet alternative to cable.
Exactly. In FWA, T-Mobile's network performance offers a truly compelling alternative to traditional cable and DSL for many people. This isn't just about phones anymore. It's about becoming the connectivity backbone for homes and businesses too.
Wow. And as societal data consumption continues its relentless exponential rise, I mean, we all use more data every year, the efficiency advantage of T-Mobile's network becomes an even more potent and durable differentiator, doesn't it?
It absolutely does. This isn't just a technological edge. It's a profound strategic one. And this moat also extends beyond the purely technological realm. Let's not forget the brand. For well over a decade, T-Mobile has meticulously cultivated a powerful brand identity as the Un-carrier, the spirited challenger fighting on behalf of the consumer against the entrenched duopoly.
Yeah, they really played that up effectively.
They did. And today, objective third-party analysis, such as that from OpenSignal, consistently shows T-Mobile has the best 5G network in terms of both raw speed and broad availability across the country. This isn't just marketing fluff. It's an independently verified reality.
And this creates a truly powerful and, frankly, quite rare combination in the consumer's mind. T-Mobile is perceived as offering both the best product and the best value. So what does this all mean for their entrenched competitors, AT&T and Verizon?
Well, this unique positioning traps them in a really unenviable strategic bind. They can no longer credibly claim network superiority to justify their historically premium pricing, at least not across the board. Yet they are structurally and culturally ill-equipped to easily compete purely on value without severely damaging their legacy brands and, more importantly, their established margin structures.
It's a truly tough spot, a classic competitive squeeze.
It really is. For you, the listener, this isn't just about who happens to be best today. It's about discerning who possesses the structural advantage that dictates where an entire industry is headed. And, crucially, who will control the future profit pools. It undeniably puts T-Mobile in the driver's seat.
Okay, this naturally leads us to a fascinating question.
Yeah.
How did all these different factors come together so powerfully? It's not just a list of advantages, is it? It's how they reinforce each other.
Precisely. It's about understanding how these distinct strengths mutually reinforce each other, creating an exponential rather than just additive advantage. The entire transformation of T-Mobile, from, a struggling third-place carrier on the brink to the undisputed U.S. wireless leader, is a textbook case of what the legendary investor Charlie Munger termed the Lollapalooza effect.
Ugh, Munger's Lollapalooza. Love that concept.
Me too. It describes an outcome that isn't the result of a single factor, but rather the powerful nonlinear confluence of multiple forces, all acting in concert, to produce a runaway result far greater than the sum of their individual parts. It's like a positive feedback loop gone wild, in the best possible way.
So it's like a series of dominoes where each one amplifies the impact of the next, creating something truly extraordinary. With T-Mobile, we see this Lollapalooza effect playing out across several critical areas. First, there's that superior contrarian asset, their strategic, almost visionary accumulation of mid-band spectrum, which culminated in that transformative Sprint merger. This gave them a demonstrably better and far more efficient 5G network. They zigged when others zag, and it paid off big time.
Absolutely. And then you have the disruptive brand identity. The Un-carrier philosophy wasn't just a marketing slogan. It genuinely tapped into deep-seated customer frustration. Frustration with the wireless industry's long-standing practices like, onerous contracts, hidden fees, data overages, all that stuff. By actively fighting for the customer, they built a loyal, almost evangelical customer base that felt truly seen and valued.
Yeah, people really responded to that. And they were incredibly astute at leveraging psychological tendencies, weren't they? Think about things like T-Mobile Tuesdays, offering free perks every week. That's a classic example of the principle of reciprocity. They give you something, and you feel a pull to stay loyal.
Or bundled services, like Netflix on Us, which ties you in with valuable popular content, makes switching harder.
And they relentlessly publicized their industry-leading customer growth figures, a powerful form of social proof that attracted even more subscribers, reinforcing their perceived momentum. Everyone's switching to T-Mobile.
Right. And beyond that, the economies of scale derived from the Sprint merger were a masterstroke. Not only did it provide that absolutely critical spectrum, but it unleashed massive cost synergies and created a network scale that dramatically lowered the per-unit cost of delivering data. This means they can serve more customers for less. Pure efficiency gain. And finally, a fanatical customer focus. This isn't just talk. It seems deeply ingrained in their corporate culture, from the top down. It manifests in tangible, measurable results, like consistently ranking first in customer care and achieving the lowest customer churn rates in the industry, meaning people simply don't want to leave. Exactly. It's truly incredible how these elements didn't just add to one another, they genuinely multiplied. A superior network made their value proposition exponentially more compelling, which in turn fueled unprecedented customer growth.
Right.
That higher customer growth generated even more scale and cash flow, which could then be reinvested back into the network, further widening their lead and reinforcing that best product, best value perception. This self-reinforcing flywheel is the Lollapalooza effect in action.
And for you, the listener, it's a powerful mental model to apply to any business you're analyzing, seeing how different strengths aren't just individual assets, but rather elements that reinforce each other to create an exponential rather than just additive advantage. It's truly a rare phenomenon to see executed so well.
Okay, now let's peel back another layer and turn to what we sometimes call the Scuttlebutt simulation. This involves looking at the business from the ground up, through the eyes of its customers and employees. Because ultimately, the true test of a business isn't just its strategic plan or its financial statements, right? It's how it's experienced by the people who interact with it every single day.
Yeah, absolutely critical. And when it comes to customer love, the quantitative data here is incredibly compelling, isn't it? T-Mobile has consistently earned the top ranking for customer care among mobile network operators for an astounding 15 consecutive reports from J.D. Power. That's not anecdotal, that's consistent, independently verified third-party validation that speaks volumes about their service quality. But for me, the ultimate barometer, the true acid test, is that postpaid phone churn. This figure represents the percentage of their most valuable customers, those reliable monthly paying ones, who choose to leave the service each month.
The leaky bucket problem, or lack thereof.
Exactly. And T-Mobile consistently reports the lowest churn in the entire industry, hitting a record low for a first quarter at just 0.86% in Q1 2024 and reporting an overall postpaid churn of 0.90% in Q2 2025. That's incredibly low. Well, you might occasionally encounter some negative online sentiment or, net promoter scores, which can sometimes be skewed by a vocal minority or specific issues. The hard data of millions of customers choosing to stay with T-Mobile month after month, year after year, that provides an incredibly clear and robust signal of deep satisfaction and loyalty. They're voting with their wallets, staying put.
Absolutely. And that leads us to another critical yet often overlooked ingredient for sustained success.
Yeah.
Employee sentiment. How does the workforce feel about where they work? A motivated, engaged workforce is a powerful competitive advantage, isn't it?
Oh, for sure. Happy employees often mean happy customers.
Exactly. According to Glassdoor data, an impressive 80% of T-Mobile employees would recommend the company as a great place to work to a friend. Now, to put that in perspective, that figure stands well above competitors like Verizon at 66% and AT&T way down at 57%. Big difference.
Wow, that is significant.
It is. Further data from Comparably indicates that 83% of employee reviews are overwhelmingly positive, with specific praise often directed at the company's culture, competitive compensation, and robust benefits packages. Now, of course, no workplace is perfect, and some criticisms do exist, particularly concerning things like sales pressure or the organizational changes following the Sprint merger.
Always challenges with big mergers.
Always. But the overwhelming sentiment points to a more positive and engaged workforce compared to its direct peers. And that commitment to employee well-being and engagement, you have to believe, directly translates into better customer service and ultimately contributes significantly to long-term success.
Okay, so let's zoom out again and look at the broader competitive landscape. The U.S. wireless market is effectively a rational oligopoly, isn't it? Dominated by three primary players: T-Mobile, AT&T, and Verizon. These aren't just competitors, they're titans with different historical legacies and strategic approaches.
That's absolutely right. Let's briefly consider their core strategies and how they compare to T-Mobile's. Verizon first. They've historically built their entire brand on being the premium network provider, consistently commanding the most reliable network title and using that as justification for, premium pricing.
Right, can you hear me now, guys?
Exactly. However, they were strategically late to the mid-band 5G game. They initially focused heavily on that high-frequency millimeter wave technology, which offered incredibly high speeds but only in very limited, dense urban areas, not broad coverage. They're now in the midst of a massive multi-billion-dollar effort, deploying their recently acquired C-band spectrum to try and catch up to T-Mobile's mid-band lead. It's an enormous, costly undertaking for them.
A big pivot for them. And then there's AT&T. Their story seems a bit more complicated.
Yeah, complicated is a good word. AT&T, frankly, pursued a more complicated and, at times, visibly distracted strategy. Their multi-billion-dollar acquisition of Time Warner, for instance, proved to be a costly diversion into the media industry. Remember that?
Oh, yeah, Warner Media. Didn't work out so well.
No, a foray from which they have since largely retreated. That strategic misstep meant capital and management focus were diverted away from crucial network investments during a critical period of 5G rollout. The company is now attempting to refocus on its core connectivity business, balancing the deployment of a national fiber network with its 5G expansion. However, it continues to lag T-Mobile significantly in both the depth of its mid-band spectrum portfolio and the sheer breadth of its 5G coverage across the country. They're playing catch-up on multiple fronts, really.
So putting it all together, for any observer, T-Mobile's key durable advantage over its rivals becomes strikingly clear, doesn't it?
It really does. It's that multi-year head start and its fundamentally superior asset base in mid-band 5G spectrum. This is not a lead that can be closed quickly or, crucially, inexpensively. That's the key part. This spectrum advantage directly translates into a superior customer experience, evidenced by faster median download speeds and broader 5G availability across diverse geographies, and a more efficient network, which means a lower cost to deliver each gigabyte of data. That efficiency is huge. While AT&T and Verizon will undoubtedly improve their networks over time, T-Mobile's established lead allows it to aggressively press its advantage into those new growth vectors we discussed.
Right, the FWA, enterprise, rural markets.
Exactly. While its competitors are still dedicating immense capital and operational focus simply to catching up in the core mobile market, T-Mobile's playing offense, while its rivals are still primarily playing defense. It's a very different strategic posture.
And for you, the listener, this isn't just about who happens to be best today, like a momentary snapshot. It's about discerning who possesses the fundamental structural advantage that dictates where the industry is headed. It's about understanding who is best positioned to capture and control the future profit pools. And right now, that really puts T-Mobile in the driver's seat for the foreseeable future. Okay. Now, even a wonderful business, one with a seemingly unassailable moat, needs excellent stewardship, doesn't it? Top-tier management to realize its full potential. So let's pivot to management, stewardship, and financial resilience. These are truly the pillars of trust for any long-term investment.
Exactly. And the story here really starts with the leadership team itself. Mike Sievert.
Right. Mike Sievert, T-Mobile CEO. He's been an indispensable architect of the company's strategy for over a decade, hasn't he? Joined way back in 2012 and became CEO in 2020. So what does this tell us as observers? His public communications consistently reflect a long-term, owner-oriented philosophy. He articulates the company's mission not merely in terms of financial metrics, but as a commitment to being the best in the world at connecting customers to their world, and crucially, using the company's immense scale and resources for good, which is, a refreshing, almost altruistic approach for a large corporation.
It is. You don't always hear that.
His commentary on their pivotal 5G strategy is particularly revealing, too. He describes the deliberate decision to focus on mid-band spectrum as a clear strategic divergence from competitors who, in his view, made the wrong bet on millimeter wave technology.
He was pretty blunt about that.
He was. And that willingness to make a contrarian long-term bet on a superior architectural approach, rather than chasing short-term marketing claims or fleeting trends, that's a hallmark of truly rational, long-range strategic thinking. He doesn't speak of merely achieving a fair share of the market. His philosophy is about earning share by consistently providing the best network and the best value, indicating a profoundly competitive, merit-based operating philosophy. He feels like an owner-operator in spirit, even if not by sheer share count.
And what's particularly fascinating here is how management's incentives seem meticulously aligned with long-term shareholder interests. A significant portion of executive compensation is delivered through performance-based restricted stock units, or PRSUs.
Okay, so not just free stock.
Right. These aren't just given out. They only vest if the company achieves specific multi-year performance goals. This directly ties executive rewards to the creation of sustainable long-term value, rather than simply, short-term fluctuations in the stock price. Now, when we examine insider ownership, while direct ownership by the executive team, excluding the controlling shareholder, is maybe a modest 0.4% of the company, that stake is valued at over $1.1 billion. That represents a very significant personal investment for the individuals involved.
That's real skin in the game.
Absolutely. Ensuring meaningful skin in the game, they truly feel the impact of their decisions. But the dominant insider, the true North Star here, is the company's controlling shareholder, Deutsche Telekom, or DT, which holds a majority stake of over 50%.
Right, the German parent company.
Exactly. This controlling interest provides a powerful anchor of stability and an unwavering long-term focus. While recent insider trading records might show more sales than buys, these are typically part of prearranged 10b5-1 trading plans.
Right, scheduled sales for diversification.
Precisely. Mechanisms designed to allow executives to diversify their personal holdings over time without any hint of insider trading based on current knowledge. These sales represent a tiny fraction of total holdings, reinforcing the overall long-term commitment.
And that stable, long-term oriented controlling shareholder in Deutsche Telekom has been a key enabler of T-Mobile's audacious and ultimately successful strategy, hasn't it? It effectively provided management with the stability and, critically, the air cover necessary to make those difficult multi-year strategic bets like the Sprint merger.
That's a great point. A company beholden to the whims of short-term activist investors might never have been able to execute such a transformative, long-horizon plan. DT shielded them, in a way.
And if we look at their capital allocation track record, it's been demonstrably rational and, crucially, has evolved intelligently as the business has matured. We can really view it as having two distinct, highly strategic phases, right?
Yes, absolutely. Phase 1, roughly pre-2023, was all about building the fortress. This era was characterized by aggressive and highly strategic capital deployment, all aimed at constructing the company's formidable competitive moat. This included massive, sometimes eye-watering capital expenditures on network build-out and a series of transformative M&A transactions.
Metro PCS, Sprint, U.S. Cellular more recently?
Exactly, the big ones. This was a period of necessary and rational empire building, acquiring the critical spectrum and achieving the scale required to win decisively in the U.S. wireless market. It was an investment phase where cash flow was largely reinvested straight back into the business.
Okay, build a fortress first. And then we pivot to phase 2. Post-2023, where the focus has decisively shifted to harvesting and returning value.
Exactly.
Yeah.
Having successfully constructed that fortress, having made those massive front-loaded investments, management is now executing a clear pivot, a pivot toward harvesting the immense cash flows of the business and, crucially, returning a substantial portion of that cash to shareholders. Their 2024 Capital Markets Day event detailed a clear, transparent plan to generate capacity for approximately $80 billion for investments and stockholder returns through 2027.
$80 billion. That's a huge number.
It's massive. This includes plans for up to $50 billion in future dividends and share repurchases, on top of the significant $25 billion already delivered to date.
Wow.
For you, the listener, this disciplined and strategic shift from a primary focus on reinvestment to one of significant capital return is the essence of a rational, shareholder-friendly capital allocation policy. It's a clear signal that the business has reached a maturity point, a financial inflection, where its core competitive advantages are self-sustaining and generating excess cash.
But they're still investing too, right? Not just returning cash.
Oh yes, absolutely. They also continue to pursue smaller, strategic venture investments and bolt-on acquisitions to plant seeds for future growth, but the overwhelming focus, the big story now, is definitely on shareholder returns.
Okay, that makes sense. Let's turn to the financial fortress itself then, the numbers.
Right. A qualitative view that truly underpins their resilience. Following this successful and remarkably rapid integration of the Sprint assets, T-Mobile's profitability has reached what we can only describe as a clear and powerful inflection point. While historical results were, as expected, somewhat inconsistent during that heavy investment phase, a period of intense capital consumption and merger costs, the past 3 fiscal years show a dramatic and unmistakable acceleration in earnings power.
Like what kind of numbers are we talking?
Well, net income, for instance, surged from $2.6 billion in 2022 to a remarkable $8.3 billion in 2023, and again to a projected $11.3 billion in 2024.
Huge jump.
Massive. Core adjusted EBITDA, a measure of operational profitability before non-cash expenses, has showed similar strong, consistent growth, rising from $27.8 billion in 2022 to a projected $31.9 billion in 2024. This isn't just growth. It's a financial rocket ship launching T-Mobile into a league of its own. It's a tangible financial result of that widening moat and increasing operational leverage finally hitting the bottom line.
And we can see this transformation powerfully reflected in some key quality ratios, can't we? Let's start with return on invested capital, or ROIC. How's that looking?
It's shown a strong upward trajectory, improving from low single-digit levels just a few years ago to approximately 8.3% on a trailing 12-month basis. Now, while that's not yet at the elite double-digit levels of maybe some software companies, the trend is decisively positive and crucially accelerating. More importantly, their ROIC now appears to be comfortably above its weighted average cost of capital, or WACC.
Which you estimated around 6.85%.
That's right, around 6.85%. For you, the listener, WACC is essentially the minimum rate of return a company must earn on its existing asset base just to cover its financing costs. That positive spread, where ROIC is greater than WACC, is the definitive financial stamp of approval every long-term investor dreams of.
Means they're actually creating value.
Exactly. It signifies that the company is not just growing, but it's growing profitably and effectively, creating, not destroying, economic value with every dollar it invests.
Excellent. What about free cash flow conversion? How much of that profit is actual cash?
Great question. This metric, often overlooked by casual investors, measures the true quality of a company's earnings by showing how effectively its reported net income is converted into actual spendable cash. After a period of understandable volatility due to massive capital expenditures and merger integration costs, T-Mobile has truly transformed into a prodigious cash generator. In fiscal 2024, the company generated an impressive $17.0 billion in adjusted free cash flow on $11.3 billion of net income.
Wow, so more cash flow than net income.
Yeah, that's a conversion rate of approximately 150%. This demonstrates exceptionally high-quality earnings. It means their profits aren't just sitting tied up in receivables or inventory. They're flowing directly into the bank. It also points to highly efficient working capital management.
Very strong. And finally, their balance sheet strength. There's still a lot of debt from Sprint, right? How manageable is that?
That's fair. Management prudently maintains a leverage target of approximately 2.5x net debt to EBITDA, which is pretty standard for the industry. Their current ratio, a quick snapshot of liquidity, sits at a healthy 2.2x to 2.4x.
Meaning they can cover short-term bills easily.
Very easily. Think of it as having over $2 in immediate assets for every dollar of short-term bills, a very comfortable position. Now, the company's significant debt load, approximately $83 billion, is remarkably well covered by its robust operating cash flow. We're talking about 30.7% coverage. And its interest payments are comfortably covered by EBIT or earnings before interest and taxes at an impressive 5.5x coverage.
Okay, so the cash flow handles the debt okay.
Yes. For you, the listener, while the absolute debt figure is undeniably large, it seems entirely manageable given the immense scale, the fundamental predictability, and the rapid growth of the company's cash-generating operations. These financial metrics aren't just abstract numbers. They tell a powerful, undeniable story of T-Mobile's transformation from a scrappy challenger to a dominant cash-generating leader. They confirm both the business's inherent strength and the management's exceptional effectiveness.
Okay, so we've laid the groundwork of the business, explored its widening moat, and confirmed the quality of its management and financials. Impressive stuff. Now we move to the final analytical hurdle: valuation, risks, and catalysts. This is where we shift to the investor's lens, asking, what does this all mean for my potential investment? Is the price right?
That's right. T-Mobile stock has historically and quite justifiably traded at a premium valuation multiple, both price to earnings, PE, and enterprise value to EBITDA relative to its peers, AT&T and Verizon.
Right, it's not the cheap one anymore.
Not for a while now. For the uninitiated, a PE ratio simply tells you how much investors are willing to pay for each dollar of a company's earnings. This premium reflects the market's consistent recognition of T-Mobile's superior growth profile. First, as that disruptive challenger rapidly taking market share, and now as the clear 5G network leader. The current PE ratio, hovering in the range of, say, 22 to 24x, reflects the market's expectation for continued strong, double-digit earnings growth in the coming years.
So this raises an important question. For a high-quality, rapidly growing enterprise like T-Mobile, where does one find that crucial margin of safety? It's unlikely to be found in statistical cheapness based on simple multiples, is it? You're not looking for a cigar butt stock here, like Buffett used to find.
No, absolutely not. That ship has sailed. For companies of this caliber, the primary source of a prudent, long-term investor's margin of safety is inherent in the business itself. It's that deepening and widening economic moat, the absolutely essential nature of its service, and the high degree of predictability in its future cash flows. This is a business built on enduring customer needs.
Okay, the quality is the safety. partly?
Largely, yes. The secondary source of safety would be an attractive purchase price that might arise from either a broader market-wide panic that indiscriminately sells off all assets,
Yep.
or, perhaps more likely, a company-specific but temporary setback.
Like what? A bad quarter?
Could be. Such setback could include a single quarter of slightly disappointing subscriber growth, maybe a minor integration issue with a new acquisition, or even a competitive pricing action that temporarily spooks the market. An investor with a firm, deep grasp of the long-term durability of this business's moat would be uniquely positioned to view such an event not as a catastrophe, but as a significant opportunity.
An opportunity to acquire a wonderful company at a potentially better price.
Exactly. Which brings us to the ultimate perennial hurdle for any investor: price. Even a truly wonderful company, one with all the characteristics we've discussed, can turn into a poor investment if acquired at a foolish price. If T-Mobile were trading at a PE multiple of, say, 50x, an investor would likely experience quite poor returns, even if the company executed its strategy flawlessly.
Because the growth is already priced in, and then some.
Precisely. Because such a price would have already discounted decades of perfect growth. The central valuation question for this deep dive is whether the current valuation of approximately 22 to 24x earnings provides a reasonable prospect for satisfactory long-term returns. Given the company's powerful business fundamentals and clear, multifaceted growth trajectory, it's about balancing that quality with the price you pay.
Makes sense. Okay, let's talk about the growth drivers then. Where does future growth come from? And maybe more importantly, what are the permanent risks that could derail this whole thesis?
Right. The single most important identifiable driver for T-Mobile's future earnings growth is the continued and expanded monetization of its superior network asset. How do they make more money from that network? This will be achieved through a multi-pronged, relentless strategy, first capturing network seekers. A primary opportunity lies in aggressively winning over high-value postpaid customers from rivals in major metropolitan markets.
People switching from Verizon or AT&T because T-Mobile's network is now better.
Exactly. These are customers who historically chose Verizon or AT&T based on a perception of a superior network quality, but who are now increasingly recognizing that T-Mobile has become the new network leader, offering better speeds and more pervasive 5G coverage in many places.
Okay, stealing share from the big guys. And they also have a significant underappreciated runway for growth in markets where their share is still relatively low, but their network advantage is now quite pronounced, right? You mentioned expanding into underpenetrated segments.
Exactly. This includes aggressively expanding into smaller markets in rural areas, which have historically been underserved by the wireless industry, as well as that enormous large enterprise segment through their rapidly growing T-Mobile for Business division. This is where the low-hanging fruit might still be plentiful.
Got it. And then there's a truly massive, arguably transformative growth opportunity in scaling the broadband business, the FWA stuff.
Yes. By cleverly leveraging the excess capacity of their vast 5G network for fixed wireless access, or 5G home internet, combined with nascent fiber-to-the-home partnerships, T-Mobile can directly compete with incumbent cable providers like Comcast or Charter. This dramatically expands its total addressable market far beyond just mobile phones, tapping into a huge segment of the connectivity market.
So they're basically turning their mobile towers into home internet providers.
In effect, yes. Bypassing the costly last-mile infrastructure that has plagued traditional broadband players, this is a potential game-changer for their long-term growth profile.
Okay, those are powerful growth engines that could propel them forward. But what about the permanent impairment risks? What could truly derail this long-term thesis, perhaps even dismantle that fortress we've been discussing?
Good question. Always important to consider the downside. The most significant and potentially impactful threat, I think, is adverse regulatory action. A fundamental unfavorable shift in the regulatory landscape. Things like government-mandated network sharing that forces T-Mobile to open up its superior network to competitors on unfavorable terms.
Or forcing them to sell spectrum.
Or forced reallocation of critical spectrum licenses, or even the imposition of price controls. Any of those could structurally alter the industry and significantly erode the value of T-Mobile's network-based moat. This is a powerful, non-market risk you always have to keep in mind with regulated utilities or near utilities.
Okay, regulatory risk is number one. What else?
Another long-term consideration, perhaps more speculative but vital to ponder, is technological disruption. The emergence of a new, truly leapfrog technology, for instance, a low Earth orbit satellite service like Starlink, becoming good enough and cheap enough that it makes traditional terrestrial networks largely obsolete for mass market mobile connectivity.
Could that really happen? Seems far off.
It seems far off now, but technology moves fast. Such a shift could fundamentally devalue T-Mobile's vast, multi-billion-dollar infrastructure investments. Now, the company is actively hedging this risk through partnerships with players like Starlink to explore satellite-to-phone connectivity. But it remains a long-term, maybe low probability but potentially high-impact consideration. Finally, there's always the risk of a return to irrational competition.
A price war.
Exactly. The U.S. wireless market has, for the most part, behaved as a rational oligopoly among three major players recently. However, a desperate strategic move by a struggling competitor could trigger a value-destroying price war that would damage the profitability of all industry participants, even the strongest. It's a risk that always looms in concentrated industries like this one.
Okay, regulatory, tech disruption, price wars. Got it. And what about potential catalysts that could unlock or accelerate value for shareholders? What specific developments or actions should we be looking for?
Well, the most tangible and immediate catalyst is the execution of the company's enormous capital return program we talked about. Management has outlined plans for up to $60 billion in returns through 2025 and is guided to a capacity for up to $50 billion more through 2027. That's potentially $110 billion over 5 years or so.
Wow, mostly buybacks.
Primarily through aggressive share repurchases, yes. This will significantly reduce the outstanding share count. For you, the listener, fewer shares outstanding mean that each remaining share gets a larger slice of the company's growing earnings. It provides a powerful accelerant to earnings per share growth, even if overall net income growth slows a bit. The recently initiated and growing dividend also provides a direct, tangible cash return to shareholders, a clear sign of financial maturity and confidence.
So massive capital returns. And I imagine this successful integration of any future accretive M&A is another one, right? Like making sure U.S. Cellular fits in smoothly.
Absolutely. The smooth and effective integration of recently acquired assets, such as the wireless operations of U.S. Cellular, which brought more critical spectrum and customers, and the continued build-out of those fiber joint ventures like Lumos and Metronet, which expand their broadband footprint, that could provide upside to consensus growth forecasts. This would further demonstrate management's continued skill in executing value-creating mergers and acquisitions, signaling that they can continue to grow strategically and integrate effectively.
Okay, this brings us to a crucial point, that second-level thinking inquiry. How does this deep dive compare to the general market consensus view of T-Mobile? What might the market be missing?
Right. The prevailing market narrative, I think, correctly identifies T-Mobile as the best-in-class operator in the U.S. wireless industry. No argument there. The consensus view readily acknowledges the company's decisive 5G network lead and its strong operational execution. However, this view is often framed within the context of a mature, slow-growing, and highly competitive domestic wireless market, implying that T-Mobile's growth will inevitably decelerate as market saturation limits new opportunities. It's often seen as, a great company in a tough, maybe ex-growth industry.
Okay, let's unpack that. While we absolutely agree that T-Mobile is best in class, the contrarian, or perhaps deeper, second-level view is that the market might actually be underestimating a few things. Underestimating the profound durability, the inherent economic power, and the truly long-term earnings potential of its network-based moat. The market appears to still be valuing T-Mobile primarily as just another wireless carrier in a saturated market, rather than what it's evolving into. The contrarian view, or the deeper view, is that T-Mobile has successfully transformed into a much broader, more dynamic connectivity provider with a significantly larger addressable market than is commonly perceived.
Right. The FWA and enterprise pieces aren't just footnotes.
Exactly. The long-term earnings power from those new segments, fixed wireless access, enterprise customers, and underpenetrated rural and smaller markets, is simply not yet fully reflected in the company's current valuation, arguably. It's likely that the true scale of the company's future free cash flow generation, as it fully harvests the returns from its multi-year network investments, is not yet fully appreciated by the broader market.
And for you, the listener, this is where the potential aha moment lies, seeing what the market might be missing. The crucial difference between a superficial understanding and a true, comprehensive deep dive into the structural advantages and future potential.
We've covered a remarkable amount of ground today, haven't we? Really dug in. From meticulously understanding T-Mobile's core business model and its growing, durable moat, through the quality of its management and its robust financial strength, all the way to its valuation profile, the potential risks, and those exciting catalysts for future value.
And through it all, we've truly examined from every angle whether T-Mobile genuinely represents that wonderful company suitable for the truly long term. It's been quite the journey.
So here's where it gets particularly interesting. Our deep dive strongly suggests that T-Mobile has indeed built a formidable and, critically, a widening moat, positioning itself not just as a wireless leader, but as a future cash-generating powerhouse with a significant runway for growth that many might still be underestimating. It's a compelling picture, one that warrants serious consideration, wouldn't you say?
It certainly paints a very positive picture based on the current trajectory and assets.
We encourage you, the listener, to reflect on these insights and consider how this deep dive framework, this systematic way of analyzing a business, can be applied to other companies you might be curious about, especially those you might be thinking of holding for decades to come.
Which raises a truly important final question, building on our Red Team challenge from earlier about permanent impairment. Given the unrelenting, rapid pace of technological innovation, can any terrestrial network truly sustain a multi-decade competitive advantage? Or is the future of connectivity inherently more decentralized, perhaps even more fluid, than even the strongest current players anticipate? What new technologies, if any, could truly dismantle what appears today to be such an enduring fortress?
A question that truly makes you think about what's next. Definitely something to ponder. Until next time, keep digging deep.